We're all following the news about the Omicron variant. As the president said yesterday, we're still waiting for more data, but what remains true is that our best protection against the virus is the vaccine, and our economy is on pace to reach full employment 2 years faster than the Congressional Budget Office had estimated. The first is the debt limit. I cannot overstate how critical it is that Congress address this issue. America must pay its bills on time and in full. If we do not, we will eviscerate our current recovery. In a matter of days, the majority of Americans would suffer financial pain as critical payments like Social Security checks and military paychecks would not reach their bank accounts, and that would likely be followed by a deep recession.
Most forecasters, including at the Fed, continue to expect that inflation will move down significantly over the next year as supply and demand imbalances abate. It is difficult to predict the persistence and effects of supply constraints, but it now appears that factors pushing inflation upward will linger well into next year. The recent rise in COVID-19 cases and the emergence of the Omicron variant pose downside risks to the employment and economic activity and increased uncertainty for inflation. Greater concerns about the virus could reduce people's willingness to work in person, which would slow progress in the labor market and intensify supply chain disruptions. So I think the word transitory has different meanings to different people. To many, it carries a sense of short-lived. We tend to use it to mean that it won't leave a permanent mark in the form of higher inflation. I think it's probably a good time to retire that word and try to explain more clearly what we mean.
Right now, there is uncertainty about where we will be on December 15th, and there are scenarios in which we can see it would not be possible to finance the government.
The threat of persistently higher inflation has grown. I think my baseline expectation is still, as I mentioned, and of most forecasters, is still that inflation will move back down over the course of next year closer to our target. But clearly the risk of more persistent inflation has risen. And I think what you've seen is you've seen our policy adapt, and you'll see it continue to adapt. We will use our tools to make sure that higher inflation does not become entrenched. Certainly through the middle of next year, that's an expectation. Forecasting is not a perfect art, as you may have noticed. But yes, right into the middle of next year, and that's our expectation. But of course, what's happened is that date has been pushed out repeatedly as supply side problems have not really improved. Elevated inflation pressures, a rapid improvement in many labor market indicators without an accompanying addition of labor supply, and also strong spending that really signals significant growth in coming months. Remember that every dollar of asset purchases actually adds accommodation to the economy. But at this point, the economy is very strong and inflationary pressures are high, and it is therefore appropriate, in my view, to consider wrapping up the taper of our asset purchases, which we actually announced at the November meeting, perhaps a few months sooner. We always think about cyber risk as being the one that's so difficult to quantify and for which it's hard to have a great playbook. So that's the one that I tend to lose sleep over. We saw high demand coming. We saw some higher inflation coming. But what really happened was this demand came and hit kind of a hard constraint in the form of these supply constraints, and that's not in the model. It's we live and learn. It's hard to model something that is nonlinear and that is incredibly infrequent. There's no precedent really for it.